Good morning, traders. It's 8:02 a.m. Chicago time on the first day of September, Thursday, the 1st, 2016. This is another Trader Bite. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not indicative of future results. The um, the market, as far as which way we're going, risk capital is moving, or capital is moving towards risk. Risk is on. Looks like we're pushing. The British pound is up, way up, 1%, trading 132.62, followed by the Euro Stocks 50 up 0.5%, and then the Russell, Nasdaq, and the DAX follow with the Dow and the S&P on their tail. And crude oil's down 41 cents, approximately 0.9%, trading 44.33. Crude was as low as 44.22, just 8 cents lower. And of course, the weakest is the U.S. Treasury bond, the Japanese yen, and the 10-year note. So this is saying that risk is moving to being on. And so we see that the market has popped a little bit overnight. Um, Other than that, as far as news, looking at the um, looking at the overall market position, there isn't too much to consider here other than the UK PMI manufacturing came in really strong at 53.3 versus 49.0. This moves the UK manufacturing sector into expansion, and this has been the highest since October 2015. New orders came in at 54.6 versus 48.3. That number came out at 3:30 a.m. Central, 4:30 Eastern. U.S. time, we got 6:30 this morning. We got August Challenger job cuts, 32.2 thousand versus 45.4 K. And then non-farm productivity came in at negative 0.6% at 7:30 Central this morning, in line. Unit labor costs are higher, 4.3% versus 2.1. And then, of course, initial claims came in at 263,000, slightly better than 265,000 expected. Continuing claims slightly worse at 2.16 million versus 2.15. Now, I'm not an economist or an analyst, but I do look at those figures to see what the market expected, or what the market generally, when you're talking about expectations, you're looking at a consensus that has a range, and that consensus is what institutions and banks and so on are betting on, and so seeing how far the numbers are off is important in describing the revaluation that occurs when these numbers come out, depending on how important the number is. So overall, the market stance is towards putting on risk today, or over the overnight session, and that's where we are currently. Let's switch gears here, and well, let's look at what we have today. At 8:45 Central, 15 minutes after the cash open, 9:45 Eastern, U.S. manufacturing PMI final, August, expecting 52.1. So look for that as soon as we just after we open. At 9 o'clock Central, 10 o'clock Eastern, we have U.S. construction spending month on month for July. The expectation is 0.5%. We're also getting U.S. ISM manufacturing for August, expecting 52.0. And with that comes ISM prices paid, 54.8. And then, of course, Natty gas at 9:30 Central, 10:30 Eastern. And then we have ECB Speaker Nowotny at 11 Central, 12 Eastern, speaking out of Austria. And then at 12:25 Eastern, 11:25 Central, we have Fed Speaker Mester, who's a voter and a leaning hawk, um, expecting to release comments on interest rates. So pay attention to that. That's it. let's take a look at what we had yesterday. Here's our Trader Bite recording from yesterday. It was a pre-recorded Trader Bite. It was done very, very early. So the opening price is off of where the market is off more than it normally is versus where the market actually opened. The primary hypothesis, given the way we finished on Tuesday for yesterday, the primary hypothesis was for the market to start to test lower early, and that's what I was looking for all morning yesterday. Test lower early, and then start looking up, start moving towards the key point of control above. So a test down early, find your buyers, and then the trend would be a sideways to a slanted up trend. That's not what we got. This plan did not work. Instead, the secondary hypothesis was to test higher early, find sellers, and start to move down. And the target to move down initially is 2165.50, but the key target, of course, is the MC point of control below 2060.75. Mentioned that throughout the week last week. We hit it last Friday right here, but we revisited yesterday. That's the secondary hypothesis again was a choppy open, test higher, find sellers, start moving lower. This is what we got. We got the choppy open, just absolutely sideways here, very compressed, an open auction in range, and then the market started to expand lower. And we could see this in the underlying sectors. We could see the underlying sectors were just bowing down before the futures actually took place. When I'm talking about underlying sectors, I'm watching these sectors right here. These 5 sectors represent approximately 75% of the market cap or the value of the S&P 500. Those sectors are the financials, healthcare, consumer discretionary, technology, and industrial. Those are the symbols that I'm following. Those are ETF symbols. It just makes it easy to follow along as opposed to what I used to do, which is to keep a basket of stocks and create my own index, which was very time consuming to keep up with the dividends and whatnot. So here's the expansion down, looking for a pullback for a continuation lower. Our first chance to take on a trade right here. Very lackluster, very, very slow, but it did work. It pulled back, and we continue. We form a zipper, continue lower, form another zipper, continue lower, and on and on and on. The most obvious move was the push into the MC point of control, and that basically ended it. I cannot say that this was a very very easy read to hop on these trades. It was very scalpy in the way it had to be traded. Once we put in that low, we have what looked like a corrective. This here was a virgin test of the lower mid, which was a valid entry. So look for the market to push. What we got is a second sigma rotation, and then look to sell it and look for it to push back into at least a consolidation zone, if not to new lows. This trade gave a scale, but had to cover and take a loss on the balance. And then here we are back in line and revisiting the top. The profile as the day was forming was very, very, very odd looking. If you look at how this, I'll try not to prolong this, but if you look at how this profile was forming through the day, let's make this a shaded profile so you can see what it is. As we move forward, it starts to build multiple distributions. There's a second distribution built there. That distribution gets stronger right there. 2 distributions with yesterday's low or the prior day's low being the cutoff point at 2168.50. That's a key number to watch. 2168.50 was later tested right here. You can see a test, but no real pullback. But as you watch this profile build, you can see what the market's doing is it's doing what it does on trend days often, which is consolidate, break, consolidate, break, consolidate, break, and to move the point of control lower and lower and lower. It didn't move the point of control, but look at how scattered this is. What this says is the market's not arriving at any consensus yet. It's still seeking value. Here's three distributions at the low, so you know that there's a high probability that if we get above 64.50, if we push through 64.50, there's likely to be a pullback and a test of 66.75. So these LVNs, for those of you who heard my at least webinar 2 on my website, these LVNs become very important to manage risk. So as you see the market pushing through here, as soon as we push through, we're likely to test the high volume node, a point of control shift right here. And as we move forward, we start to basically fill in those LVNs. But the LVNs help you gauge your risk and become a way to control risk on any trades that you take, as a way of defining where the stop needs to be. The market pushing through an LVN is essentially likely to pull back through the LVN and then push to the high volume node, the next high volume node up, and that creates some trade opportunities, and that created this trade opportunity here, which I was not on, unfortunately. But overall, the market finished with a profile that is elongated. We had a normal variation profile. Note how tight the oh, is this correct? This is not correct. I thought the IB is fairly tight here, but it doesn't look like it's correct. So I need to look into that. But in either case, we extended the IB multiple times lower in one direction, and then the market came back in and finished inside of the IB. The expectation in that situation is for the market to continue higher in the overnight session. What did we do in the overnight session? It's exactly what happened here. We have a consolidation zone through the beginning of the Asian session. We start to push higher as the Asian markets open up, and we have a profile again that is a multiple distribution profile. This is a market that's continuously seeking value and is unable to find consensus on a day-to-day basis. It's able to do so on the MC. In other words, what this is indicating is whether you detect it or not, there is intermediate to high other time frame traders, participants here participating at these prices, and you can only detect that by putting what we call a microcomposite or a volume profile that covers many days. So you can see what their activity is. But overall, the market has pushed to new highs, has pulled back, has rotated down, has had a pullback, and is now doing the continuation move down with a low, an overnight low that is fairly weak. So this brings the market back, inventory back into line. Inventory is basically balanced. The price inventory is against yesterday's close, and delta, the volume inventory, is fairly back to zero. And so this is where we stand now. What that means is that there's no clear edge to one side or another today. Let's expand our composite profile to see where we are, if anything shifted. We still have the MC point of control above, and that's going to continue to be our target in the meantime. And we have taken away some of these low volume nodes. We filled in some of these low volume nodes at 2173. If we look at the bigger profile, we see that it's becoming fairly blunt. We may be here for a little bit longer, probably waiting on Friday's numbers to see what is next. Real quick, I want to show you the how August ended. This is August. This is the entire month of August's profile. This is the volume profile. This is the market profile right here, which is time-based. And if you look at August, very condensed, a very condensed month. Even if you compare it to all the other months, you could see that January, February were just splendid, really great trading months. You could see how thin and elongated those profiles are. Much easier trade. We carry that into March, thin and elongated. April, we start to fatten up a little bit. We start to fatten up with a double distribution. May, we cover the same distribution. You can see that May covers the same distributions as April. The fatness is in the same spots. June, slightly elongated. We get some pretty decent opportunities in June, but mainly because of a Brexit. And then since then, we hopped out of that. We hopped out of that zone in the first week of July. We hopped out of all of this and we went into essentially the rest of the month of July has been here, and then August has been here. Really tough trading. It's not an excuse to lose your mind when it comes to managing risk and so on. But to put things in perspective, if you look at these 2 months, these are a tough trade. Again, the key figure right here is 2160 from July, which we just tested last Friday, and then above we have 2180, 2179 half on the market profile. Look at how thick this is. It's incredible how many TPOs are actually in these prices. It's very thick, very balanced. The move out of here, if the auction followed regular, just common auction principles, if the auction followed those, the move out of here is likely to be fairly strong. Here's the weekly. These are weekly profiles. And so far, we've been expanding, like I indicated earlier in the week on Monday. And this week is inside of last week. We've been stuck this week so far. We've tested above the high volume node above, and we've tried to test the tail below, and we're still having an inside week. Hopefully, Friday will change that with the non-farm payrolls release. Not much to glean from the weekly. Let's take a look. I'm running out of time here. Let's take a look at today. Guess what? We're in the same basic position we've been in for the last week. So what are my hypotheses? Given that the point of control has shifted up and then has shifted down, and then yesterday it has shifted down again, with the market pushing against the overnight lows and trading back in line with yesterday's point of control, guess what? We're likely to open in an open auction because we are in value. The market is accepting this, except given the trend that we're following, lower price action. In other words, one-time framing up on a daily basis. This is your pivot day, your prime day, lower high, lower high, lower high. The expectation is the market is likely to attempt higher and then start moving down yet again. That is the primary hypo. We have price and the point of control shifting lower and lower as the market continues to try to push higher and fails to do so. Again, this is Thursday, tomorrow's Friday, no news there, but tomorrow is a very important release for the Fed. The Fed is itching to raise or do something in September and is likely to do something by the end of the year according to market participants. The alternative is for the market to test the overnight low early, attempt to push lower, find its buyers, and starts moving and reversing this one-time framing down, and then starts to attack this MC point of control 2179. Again, that would be hypo 2. My primary hypo is to look for shorts today in line with where the market is pushing, and we'll see how that works. If we get an open and it starts to drive up, of course I'm going to scrap that idea and look for areas to lean long and start looking at my third and fourth hypos. Okay, so that's how things are shaping up. As always, just take your time, bide your time and wait for the market to come to you. You have your plan in place, so just wait for price to come to you, and then take the risk and let the market do what it's got to do with your trade once the trade is on. Just don't give too much room to your trades just because the action is kind of slow. I mean, you can play the market back quickly, do a quick replay, and you'll be able to see what its intent is if volatility was up. Okay. Good luck today, and I'll catch you tomorrow morning. Non-farm payrolls should be an interesting morning tomorrow. Take care.